so if you don't mind, I've been taking down a lot of those questions while you've been chatting. So I'll send through a couple of those questions. Quite a few of them at the moment, obviously, as you can imagine, the South African trust structure is very popular from an investment point of view. So you've referred to South African holdco and getting assets held in a South African company abroad. But what happens if I have direct investments in my local trust? How do I get those assets into this offshore structure? And further to that, do you think it's plausible that from an exchange control point of view, local trust may be able to invest directly offshore in the future? You're on mute.
Before I get into a flourish. Yeah, those are both excellent questions. Let me deal with the second one first. The second one, I don't know. Trust, for some reason, you've never been able to own offshore assets. So maybe this hate relationship that regulators have with trusts will continue, and they're not going to let South African trusts externalize funds. To me, that will not achieve much, because even with loops, to some extent, you've opened at least one of the floodgates. Okay. So the loop does allow investment back in, but as you can see, it also allows for ownership abroad. So I would say I wouldn't get too hung up on whether or not they allow trusts to invest abroad, because there are strategies that can easily be implemented, which will help this trust take its funds and get them abroad, if that's what the family want to do. I'm hopeful, though, if we're going to get rid of exchange controls, let's do the whole deal. I'll say one last thing on that. I'm not sure that even if they do let trusts invest abroad, that you would keep your primary estate planning location as South Africa. In other words, even if your trust could invest abroad, I'm not sure that it wouldn't be worthwhile rather moving the assets into a foreign structure than keeping your South African trust as a primary estate planning base. The second question, Daryl, what if my trust owns the assets directly? A lot of the structures do work better where you're moving corporates, okay? And for that reason, many of you will have heard of Section 42. If you haven't heard of Section 42, don't worry about it. But Section 42 is a section in the Income Tax Act that creates a dispensation where effectively taxpayers are moving assets into companies. So to answer your question, it's very, very easy if a trust has assets held in its name directly to corporatize those assets by moving them into a corporate entity using Section 42 of the Income Tax Act. And that will lead to no tax charge at the time that you do that.
That's great. Okay, also a lot of questions being asked here, Andrew. Just to clarify, please. So you're moving assets from South Africa abroad into a structure. Am I moving those assets out of my estate?
Yes, very good question. And one of the really significant impacts can be that, so recently, and it's just coincidence, I've consulted with a number of high net worths who still own substantial assets in their own names, and in particular, the family companies. Because we will move those assets into a foreign estate plan, there are techniques to do it where you will move them out of your estate. And if you think back to the diagram that I showed earlier where I used your name, Daryl owned nothing except he had an interest in the foreign trust, and the assets were wholly owned or substantially owned by the foreign trust. So yes, part of the goal is to move them out of your estate into that foreign structure.
Would you not have created, sorry, just to clarify again, would you not have created a loan into the foreign company which would still form part of your estate, but future growth in those assets wouldn't?
There are several structures available, some of which you do create a loan, but others in which you don't. And the reason that I'm being a little evasive on that, Daryl, is I don't want to get into the detail. They get quite technical, and I suspect we might lose some of the audience. But let's suffice to say, there are ways you can do it where you don't create a loan asset. And I would suggest, I don't want you to field a million calls, Daryl, but I would suggest that if people do have questions, that they raise it with you guys, and if you guys will see fit to bring me in or whoever to discuss ways of achieving that.
Yeah. Okay, Andrew, you referred a few times to more tax-favorable jurisdictions from a dividend withholding tax perspective. Can you give us a couple of examples of a few of those jurisdictions? Which are the more popular ones for South African investors in your experience?
Yes. So as I said, many of the double tax agreements drop the dividend withholding tax to 5%, and that includes Mauritius, and in fact, most of the countries do. Some of the countries that drop it to zero are, for instance, the UK, Netherlands, Sweden, Malta. So there are a couple of jurisdictions that drop it to 0%. And if I can bore you for 1 minute, Daryl, a lot of people say, how is it possible that our treaties allow this? So, if I keep the dividend owned in South Africa, it's 20%, but by moving it abroad, it's 0%. And the answer is that when a lot of these treaties were negotiated, the older of us in the audience will remember there was a thing called the secondary tax on companies. And the secondary tax on companies was, in all respects, a dividend tax, but it was levied on the company rather than the shareholder. So when they negotiated these treaties, they weren't giving anything away by lowering the dividends tax rate as they have done, because the dividend withholding tax clauses in the treaties didn't impact STC. So in other words, it was a bit short-sighted when they did the treaties to say, well, we don't care, our dividends tax is levied on the companies. When we switch to a dividend tax on individuals, this opportunity arises. And the reason that it's never been publicized before is why? We couldn't loop.
Got you. So if you could just rehash, and this is not new, but what are the requirements currently to be deemed a non-South African tax resident?
Great question as well. So one of the tests is what we call an intention test, and it's called ordinarily resident. It's the primary test. And you're ordinarily resident in South Africa if you regard it as your home. Now, that sounds a little bit woolly, but you will say, I regard South Africa as my home, then you tax resident, or I don't, I regard somewhere else as your home. And then what the test entails is to check whether or not that's true. And some of the indicators of the place that you regard as your home is, where does your family live? Where's your business? Where's your center of vital interests? Where have you reserved a grave site? Has been something. So there's a lot of sort of quite twee little tests that we apply. But the primary test is an intention test as to where you regard as your home. The second test, okay, which doesn't actually apply to South Africans because most of us are ordinarily resident, is a physical presence test. And that's for somebody who has traditionally not lived in South Africa and then comes to South Africa and lives here for extended periods of time. If they meet certain thresholds, they can become tax resident on that basis. The one thing I just want to caution, everybody says to me, I'm not tax resident, I've been counting my days. It's gobbledygook, okay? It doesn't matter how many days you spend in South Africa. Don't tell me about 183 days. They relate to other tests completely. You can spend 600 days consecutively out of South Africa and still be ordinarily resident in South Africa if you regard it as your home. So ordinarily resident is the one that people misunderstand, and it's a key test.
Right, okay, so I'm in the process now of immigrating, 2021. I'm in process right now. What does that mean for me once I've got the green light? Does that mean that I can take out more than my 1 million rand single discretionary without the need for any tax clearances, any further approvals, or what are their actual implications?
Yeah, so the way I read it, and please bear in mind, as I said to you, it's so new, it came out on Monday. The way I read it is as follows. You will need to immigrate for tax. You can no longer financially immigrate, i.e. immigrate for exchange control, without immigrating for tax. Okay, so you will need to cease to be ordinarily resident, or you will need to be breaking the physical presence test if you were an import, if I can put it that way. Okay, so you need to do your exit tax return, your CGT return, where you, number one, they ask you, did you immigrate during the year of assessment? You're going to say yes, and then there's going to be deemed CGT. You will then have to do a tax clearance certificate, which will be a specific one that will confirm that you have immigrated during that tax year. Okay. You will then go to exchange control. As I say, your allowances are now aligned to residence allowances. So number one, you can take out your R1 million discretionary allowance just with AD approval. Easy. You can take out the 10 million offshore investment allowance. Relatively easy, particularly if you've got your tax clearance certificate. Anything over and above that, currently they say it has to go to SARB. But my sense, given that they are releasing block funds of past immigrants now, if I read the notice correctly, my sense is that as long as you've done your regulatory tests and you can prove anti-money laundering source of funds, full tax compliance, they will let those funds go abroad. And just as an anecdotal piece on that, in recent times, over the last 6 months to 12 months, people have moved some really significant amounts using specific approvals to move funds which go to the SARB. So there is a trend showing that SARB is letting substantial amounts go.
A couple of questions just to everyone in the audience today asking about recordings of this. There will be a recording that is sent out to everyone that was attending today, so you don't need to worry about that if you need to log off earlier than the allotted time. Andrew, let's talk a little bit about retirement funds, living annuities, preservation funds and the like. Any changes there? Am I now able to take out my living annuity in one shot or still restricted?
The restriction on those sorts of products has now been moved to, you have to have been a tax immigrant, i.e. you have to have immigrated for 3 consecutive years before you can move those. So previously, once you did that form I referred to, the MP336, and you ceased to be an exchange control resident, you could access your pension funds and take them abroad. Now, and I'm not a pension fund expert, so if I use the wrong terminology, you'll help me, Daryl, but certainly pension funds, I can say with confidence, you need to now have been tax resident for a uninterrupted period of 3 years before you'll be able to move those funds.
Is there a limitation on the nature or percentage of the South African asset that the offshore structure can hold?
No, there is none. And I sort of alluded to this. For me, this is very significant. And I've spent a good part of this year in discussions with authorized dealers who are really the liaison between us and the Reserve Bank. Legally, the current amendment deletes all prohibitions on loops. Okay. So even where people are getting used to what's happened, and it's for some people, it's a slow process, very difficult to accept that loops are gone in their entirety. But there isn't a type of loop that is prohibited anymore. It isn't like you can loop, but not in these instances or only up to this percentage. The prohibitions, the sections that prohibit loops are gone. And as a lawyer, I read that, and perhaps I'm biased, but I read that to say any loop is fine. So in my view, there is no limit on assets. You may have heard in the market that you can only do it with pre-existing offshore funds. I strongly believe that is incorrect. You can take funds abroad and fund an acquisition under a loop. The prohibition against loop, the sections that prohibited them are deleted.
Quite a specific question. So if I've moved funds into another SADC country, let's use an example to buy a property, am I still required to repatriate those funds back to South Africa if the property is sold?
So when you say SADC, I'm going to just use a different terminology, if you don't mind, common monetary area.
Yeah.
Okay. Common monetary area is important because that's Lesotho, Swaziland, and Namibia, which are under the exchange control regime, and there you could move funds broadly. SADC does include some countries that are outside of the common monetary area, and there you would need to look at your approval. You would have got an approval, whereas in the common monetary area you wouldn't. One of the interesting things, though, is to have a look now. Those clients that we've got that have moved funds greater than 11 million in a particular year, a lot of them came with conditions. And to your point, investments into SADC may have come with conditions as well. It's now worth revisiting, in my view, whether or not exchange control are still going to apply those conditions. In other words, if I moved 500 million in 2019 and there are a whole lot of conditions imposed, I don't think there's much to lose in going back to my AD and saying, I see there's been some changes. Is it true that these conditions are still apply, or can we get some relaxation? And in all cases, you'll be better off if you can get the conditions removed. I'm not guaranteeing it. I'm just saying it's worth doing.
Yeah. All right. Andrew, I'm going to ask you one more question, an unanswerable question, if you don't mind. And then I'll let you wrap up from our side. Just again, to the audience, we've got a lot of questions coming through, very specific questions around individual situations. So this is an evolving process, and we will endeavor to keep everyone updated as things change. But from an advice point of view, as Andrew and certainly I've mentioned a few times, please feel free to contact Anchor, your financial advisor, or Andrew directly for further advice on individual situations. Right, so the unanswerable question, Andrew, is I go through this entire process. I pay a lot of money, or potentially not a lot of money, but I pay money. I leak some tax if I don't use Section 42. I get everything into my offshore structure. I've got my estate planning right, and things change. what do you think the likelihood of some of these relaxations coming into play are changed, at least in the foreseeable future?
It's a great question, and it's one I always get asked. Number one, although many individuals don't do it this way, estate planning is a dynamic process and it deals with the here and now. Every day that you wake up, you must make sure that you've got the best estate plan. And that means the best for the current regulatory regime. You can't plan for future regimes because you don't know what they are. But it is important what I said. To me, the trend is clear. Things are going to get better, not worse. Now, it's not impossible that exchange control, there's a massive policy change within the government, and somebody wakes up and says, we've made a huge mistake. They fire Tito and Mboweni, and they say, we've made a huge mistake by relaxing exchange controls. We're going back. That's not impossible. It's unlikely, but it's not impossible. Me personally, I'd rather have gone through the door legally while the door was open than be dealing with and have to deal with that scenario than not do it because I'm worried about a future policy change. So that's a policy change to the negative. I think it's unlikely, but I believe you should all be doing your relocate to estate plan now because we know what the rules are now and they're favorable. Let's do it when the rules are favorable. That said, once you are into an offshore estate plan, if you don't have one now, or even if you do have one, it is a much more complex structure and it requires constant updating, which is why many people who have these estate plans deal with people like Daryl because they keep it current, okay? And it is possible that we're going to have to monitor laws. You may have paid more tax than you will in future. I don't know. So maybe there's a future change. It's such a drastic change that, in fact, if we had just waited, we could have done it better. Again, I just come back to the point. Estate planning is a here and now exercise. And we just can't predict what's going to happen. And I think the here and now is favorable. I think people should be moving now in the next few months to make sure that they get their structures up.
Said that was the last question, but there have been quite a few questions around this topic, so I'm going to ask it, and please feel free to say it's not in your area of expertise. Okay. We've talked a lot about the use of offshore structures from an estate planning point of view. Now let's talk a little bit about situs taxes, Andrew, and assets held directly by South African or foreign investors in jurisdictions like the US and the UK, listed shares. Yeah. Is situs something we need to be concerned about? Is this a mythical beast that everyone threatens us with but never gets enforced, or is it a real consideration?
Well, let me give you my experience and then you can weigh in as well. I'm sure you guys have seen it. To me, it is a real consideration, okay? And these taxes are very, very complex. We did recently, a South African bought a big farm in the UK. The situs tax, as you can see, CMS is part of a global network. We've got a massive, massive office in London. We did some really, really sophisticated planning around the situs tax in the UK. If you get it wrong, okay, the tax in both the UK and America, and I stand to be corrected, I think they're around the 40% mark. So it's an absolutely massive tax. Now, there are structures that can be implemented which can ensure that you're not subject to the situs tax. Many of them tie in neatly to our estate planning structures, so it's not like they're additional expensive structures. But to me, when I'm investing abroad, and this is the advice I always give people, make sure that you understand the regulatory framework in the jurisdiction that you invest in, and that includes situs taxes. And if you can't structure around it, if you do your calculations on your returns, and then you factor in that you're going to die one day and you're going to get hit with 40% there, I think it's absolutely terrifying. And I think it's a disincentive to invest in those jurisdictions. If I couldn't manage the situs taxes, I believe that in many cases, that level of tax will undermine your return. So, but the good news is that you can often manage them. In other words, you can create structures where you don't trigger the situs tax, but it requires specific advice from offshore advisors. And I stress that. A lot of South African advisors believe they know the rules. They are nuanced. Please take local advice when you are navigating things like the situs tax.
All right, perfect. Thank you, everyone, again. In addition to the recording, which, as I've mentioned, will be sent out, Anchor, with Andrew's assistance, will be putting together a document highlighting some of the key themes that we've spoken about today. The process is fluid, and we'll keep you up to date as things progress. Appreciate all of your time. Andrew, appreciate your time and insights. Everybody have a fantastic day further.